Financial markets. Financial markets are platforms where buyers and sellers trade financial instruments, such as stocks, bonds, currencies, commodities, and derivatives. These markets facilitate the flow of capital and enable businesses, governments, and individuals to raise funds, invest, manage risks, and conduct various financial activities. Why do we care about financial markets from a business perspective? Capital raising. Businesses can raise capital by issuing stocks or bonds to investors in the financial markets. This funding allows companies to expand operations, invest in research and development, or undertake new projects. Investment opportunities. Financial markets provide businesses with opportunities to invest surplus cash and generate potential returns. Companies can diversify their investments to optimize their financial performance. Risk management. Financial markets offer various financial instruments that businesses can use to manage risks, such as currency fluctuations or interest rate changes. Hedging strategies can protect businesses from adverse market movements. Access to liquidity. Publicly traded companies can offer their shares to a wide range of investors, providing liquidity to shareholders who may want to buy or sell their shares in the financial markets. Benchmarking. Financial markets serve as a benchmark for companies' performance. The stock price and credit ratings are indicators of how the market perceives a company's financial health and prospects. Critical regulatory policies in the U.S. financial system. Securities and Exchange Commission, SEC. The SEC is the primary regulatory agency overseeing the U.S. securities industry. It aims to protect investors, maintain fair and efficient markets, and ensure companies provide accurate and timely information to the public. Federal Reserve, the Fed. The Fed is the central banking system of the United States. It plays a crucial role in monetary policy, controlling the money supply, interest rates, and overall economic stability. Federal Deposit Insurance Corporation, FDIC. The FDIC insures deposits in banks and savings institutions, providing confidence to depositors that their funds are protected, even in the event of a bank failure. Commodity Futures Trading Commission, CFTC. The CFTC regulates the commodity futures and options markets, ensuring fair practices and preventing fraud or manipulation. Financial Industry Regulatory Authority, FINRA. FINRA is a self-regulatory organization that oversees brokerage firms and brokers, promoting fair and ethical practices in the securities industry. Why are these regulatory policies important? Investor protection. Regulatory agencies protect investors from fraudulent activities and ensure they have access to accurate and transparent information when making investment decisions. Market integrity. Regulations help maintain fair and efficient financial markets, preventing market manipulation and promoting healthy competition. Financial stability. Regulatory policies aim to enhance the stability of the financial system, reducing the risk of financial crises and supporting economic growth. Confidence and trust. Clear and robust regulations foster confidence and trust among investors, businesses, and the public, promoting a well-functioning financial system. Consumer safeguarding. Regulatory oversight ensures that financial products and services meet certain standards, protecting consumers from deceptive practices and promoting financial literacy. In simple terms, financial markets are platforms where financial instruments are bought and sold. Businesses care about financial markets because they can raise capital, manage risks, and invest surplus cash. To ensure fair and efficient markets and protect investors and consumers, regulatory policies are in place. These policies promote trust, stability, and integrity in the financial system, benefiting businesses and the overall economy. Capital markets. Long-term financial needs. Capital markets are a segment of the financial market that deals with long-term financing and investment. They provide a platform for raising funds for businesses and governments to meet their capital needs for extended periods. Capital markets facilitate the buying and selling of long-term financial instruments like stocks and bonds. Primary markets. The primary market is where new securities are issued and sold to the public for the first time. Companies and governments raise fresh capital by issuing stocks through initial public offerings, IPOs, or by selling bonds to investors. In the primary market, businesses directly interact with investors to obtain funding. Importance of primary markets. Capital raising. Primary markets play a crucial role in helping businesses and governments raise new capital to finance their expansion, projects, or infrastructure development. Investment opportunities. Primary markets offer investors the chance to buy newly issued securities at the initial offering price, providing opportunities for potential capital appreciation and long-term investment growth. Economic growth. By providing a means for companies and governments to raise capital, primary markets contribute to economic growth, job creation, and infrastructure development. Secondary markets. The secondary market is where previously issued securities are bought and sold among investors. It is a marketplace where investors trade stocks, bonds, and other financial instruments that have already been issued in the primary market. The transactions in the secondary market do not directly involve the issuing company or government. Importance of secondary markets: liquidity. Secondary markets provide liquidity to investors, allowing them to buy or sell securities at any time. This enhances the attractiveness of long-term investments by providing an exit option if needed. Price discovery. The continuous trading in the secondary market determines the market price of securities, reflecting the collective perception of the company's or government's performance and future prospects. Efficient capital allocation. Secondary markets facilitate the flow of capital to where it is most needed. Investors can buy and sell securities based on their expectations, and companies' stock prices reflect market sentiment and valuation. Investor confidence. A well-functioning secondary market instills confidence in investors, knowing they can readily sell their investments if required. This, in turn, supports the primary market as investors are more willing to participate in initial public offerings. In simple terms, capital markets address long-term financial needs. The primary market is where new securities are issued and sold to investors for the first time, providing companies and governments with fresh capital. The secondary market is where already issued securities are traded among investors, offering liquidity and price discovery. Both primary and secondary markets are crucial for economic growth, efficient allocation of capital, and investor confidence. Financial market environment. The financial market environment refers to the overall system where various financial instruments are bought and sold, allowing individuals, businesses, and governments to raise capital, invest, and manage financial risk. It plays a crucial role in facilitating the flow of funds between those who have excess capital, investors, and those who need capital, borrowers. The financial market environment consists of different markets, such as capital markets and money markets, each serving distinct financial needs. Capital markets, long-term financial needs. Capital markets are where long-term financial instruments are traded. These markets are essential for raising long-term funds, typically for periods exceeding 1 year. They enable businesses and governments to fund major projects, expand operations, and meet long-term financial obligations. Investors in capital markets are generally seeking to invest for extended periods and earn returns through dividends, interest, or capital gains. Example of capital markets: primary markets. In the primary market, newly issued securities, such as stocks and bonds, are sold directly by issuers to investors. Companies or governments use the primary market to raise capital for the first time by issuing initial public offerings, IPOs, or issuing new debt. The primary market is crucial because it provides an opportunity for companies to raise funds for growth and expansion, which in turn contributes to economic development. Secondary markets. The secondary market is where existing securities, previously issued in the primary market, are bought and sold between investors. In this market, investors trade securities with each other, and the proceeds from these trades go to the selling investors, not the issuing company. Secondary markets are vital as they provide liquidity to investors, allowing them to buy or sell their investments without requiring the involvement of the original issuer. This liquidity enhances investor confidence, making the primary market more attractive to potential issuers. Money markets. Short-term financial needs. Money markets are designed to meet short-term financial needs, usually for periods of 1 year or less. Participants in money markets are typically seeking low-risk investment opportunities for their excess funds. These markets play a crucial role in facilitating short-term borrowing and lending, ensuring smooth cash flow management for financial institutions, corporations, and governments. Overall importance. The capital and money markets are essential components of the financial system for several reasons. Capital formation. Capital markets facilitate the flow of capital from investors to companies and governments, enabling them to finance projects and investments that contribute to economic growth and job creation. Efficient allocation of capital. By providing a platform for buying and selling securities, capital markets ensure that capital is allocated to its most productive uses. This helps direct funds to companies with the most promising prospects, fostering innovation and competitiveness. Liquidity. The presence of secondary markets in the capital market ensures liquidity for investors. It allows them to convert their investments into cash quickly, which increases confidence in long-term investments. Risk management. Investors use capital markets to diversify their portfolios, reducing risk by investing in a variety of securities with varying degrees of risk and return potential. Economic indicators. The performance of capital markets is often seen as a reflection of the overall health of the economy. Bull markets and bear markets can signal economic trends and investor sentiment. Short-term financing. Money markets provide short-term funding to financial institutions and corporations, enabling them to meet their working capital requirements and manage liquidity effectively. In conclusion, both capital markets and money markets play crucial roles in the functioning of the financial system. They provide the necessary mechanisms for raising long-term and short-term funds, supporting economic growth, and enabling investors to manage risk and achieve their financial goals. The smooth operation of these markets is vital for overall economic stability and prosperity. Financial market environment. In the financial market environment, various markets facilitate the buying and selling of financial instruments to meet the diverse needs of participants. The primary market and the secondary market are two essential components of this environment. Primary market. Corporation. In the primary market, corporations are the issuers of financial instruments, such as stocks or bonds. They seek to raise capital by offering these instruments to the public or institutional investors. Corporations use the funds they raise from the primary market to grow their business, finance new projects, expand operations, or meet other long-term financial needs. Intermediary or investment bank. An investment bank acts as an intermediary in the primary market. It assists corporations in the process of issuing securities to the public. Investment banks help with various tasks, including pricing the securities, coordinating the offering, marketing the securities to potential investors, and handling regulatory compliance. Primary investors. The primary investors in the primary market are individuals or institutions who purchase the newly issued financial instruments directly from the corporation. These investors include mutual funds, pension funds, and individual investors. They are interested in buying these instruments to potentially benefit from future returns, such as dividends or interest payments. Importance of the primary market. The primary market is essential because it allows corporations to raise the initial capital they need for their operations and expansion. By issuing stocks or bonds, companies can access funds from the public and investors, which they can use to fuel growth and finance their long-term projects. The involvement of intermediaries, such as investment banks, streamlines the process, making it easier for corporations to bring their securities to the market successfully. Example to support the keynotes. Let's take the example of a tech startup, InnovateTech Incorporated, which has developed a groundbreaking software product and is looking to expand its operations. To raise capital for growth, InnovateTech Incorporated decides to issue shares of its company in the primary market through an initial public offering, IPO. An investment bank is engaged as an intermediary to help InnovateTech Incorporated in the IPO process. The investment bank advises InnovateTech Incorporated on various matters related to the offering, such as determining the number of shares to issue, setting the IPO price, and handling the legal and regulatory requirements. The bank also markets the IPO to potential investors, including individual investors and institutional funds. During the IPO in the primary market, primary investors, which can be individuals or institutions, purchase shares of InnovateTech Incorporated directly from the company. The funds raised from the IPO will now be available to InnovateTech Incorporated to finance its expansion plans and develop new products. Secondary market, primary investors. In the secondary market, primary investors who initially purchase the financial instruments from the primary market can choose to sell them to other investors. These primary investors may decide to sell for various reasons, such as realizing profits, adjusting their investment portfolios, or responding to changing economic conditions. Secondary investors. Secondary investors are individuals or institutions who buy financial instruments from the primary investors in the secondary market. These investors do not have a direct relationship with the corporation issuing the securities. Instead, they trade existing securities with each other based on market demand and supply. Importance of the secondary market. The secondary market is crucial for several reasons. Liquidity. By providing a platform for buying and selling existing securities, the secondary market ensures that investors can convert their investments into cash quickly. This liquidity is vital as it enhances investor confidence, making primary market investments more attractive. Price discovery. The secondary market plays a significant role in determining the prices of financial instruments. Prices are influenced by the supply and demand dynamics of the secondary market, providing valuable information on the perceived value of a company's securities. C. Investment flexibility. Secondary investors can easily enter or exit positions, allowing them to adjust their investment portfolios to respond to changing market conditions or personal financial goals. Capital recycling. The secondary market allows primary investors to sell their holdings and reinvest the proceeds into new opportunities, contributing to the efficient allocation of capital. Example to support the keynotes, continuing with the example of InnovateTech Incorporated. After the successful IPO of the primary market, its shares are now listed and traded in the secondary market. Primary investors who bought shares during the IPO may decide to sell their holdings if they believe the share price has increased significantly, allowing them to realize profits. Secondary investors, such as individual traders or institutional investors, can now buy these shares from the primary investors in the secondary market. The secondary market allows these investors to participate in the potential growth of InnovateTech Incorporated and become shareholders without the need to directly interact with the company. Additionally, the secondary market provides liquidity to both primary and secondary investors, as they can easily buy or sell shares at prevailing market prices. In conclusion, the primary market serves as a platform for corporations to raise capital by issuing financial instruments, while the secondary market facilitates the trading of existing securities among investors. Both markets are essential for companies to grow and investors to find opportunities to invest and manage their financial assets. The primary and secondary markets together form a robust financial ecosystem, promoting economic growth and efficient allocation of capital. Financial market environment acts and rules. These are laws and regulations implemented by governments and regulatory bodies to oversee and govern the functioning of financial markets. They are designed to ensure fair practices, stability, and investor protection. Maintaining a healthy financial system. A healthy financial system is crucial for the overall economy's stability and growth. It provides a reliable platform for businesses to raise capital, individuals to save and invest, and facilitates efficient allocation of resources. Regulations trigger specific behavior. Financial regulations are crafted to encourage certain behaviors and discourage others. For instance, regulations may be put in place to promote transparency, reduce risks, prevent market manipulation, and protect consumers. Importance of financial market regulations. At investor protection. Regulations aim to protect investors from fraud, scams, and unethical practices. By enforcing rules on disclosure, fair dealing, and transparency, investors can make more informed decisions, boosting their confidence in the market. B. Stability and systemic risk. Regulations help mitigate systemic risks and prevent financial crises. By imposing capital requirements and risk management standards on financial institutions, authorities can reduce the likelihood of market-wide failures. C. Fair competition. Regulations promote fair competition by preventing market monopolies and ensuring a level playing field for all participants. This fosters innovation and efficiency in the financial industry. D. Market integrity. Rules against market manipulation, insider trading, and fraudulent activities maintain the integrity of financial markets. This instills trust among investors and encourages long-term participation. E. Consumer protection. Regulations safeguard consumers from abusive practices, ensuring financial products are suitable for their needs and understanding. This prevents mis-selling and exploitative behavior. Example: the Dodd-Frank Wall Street Reform and Consumer Protection Act, USA. The Dodd-Frank Act, passed in response to the 2008 financial crisis, is an example of comprehensive financial market regulation. It addressed various aspects of the financial system to improve stability and protect consumers. Systemic risk oversight. The Act created the Financial Stability Oversight Council, FSOC, to identify and address risks posed by large financial institutions and prevent potential system-wide failures. Consumer Financial Protection Bureau, CFPB. Dodd-Frank established the CFPB, an agency dedicated to protecting consumers from unfair and deceptive practices in financial products and services. Volcker Rule. This rule prohibits banks from engaging in certain types of speculative trading with their own funds, reducing the risks associated with proprietary trading. Derivatives regulation. The Act introduced regulations for the derivatives market, aiming to increase transparency and reduce risk by mandating central clearing and reporting of derivative transactions. Mortgage reforms. Dodd-Frank implemented rules to improve mortgage lending practices, including enhanced underwriting standards, banning certain risky mortgage products, and requiring lenders to verify borrowers' ability to repay. By implementing these measures, the Dodd-Frank Act aimed to create a more transparent, stable, and consumer-friendly financial system. However, it's worth noting that financial regulations should strike a balance between stability and innovation, as excessive or poorly designed regulations could stifle economic growth and innovation. Investment decision process. Investors follow a systematic process to evaluate whether they should invest in a company or not. This process involves gathering information, analyzing data, and making an informed decision based on various factors. Importance of decision process. Making investment decisions based on a structured process helps investors minimize risks, maximize potential returns, and align their investments with their financial goals and risk tolerance. Investment decision process steps. Step 1. Research and analysis. Investors conduct research on the company's financial health, market position, and growth prospects. They examine the company's revenue, profitability, debt levels, and competitive advantages. Step 2. Industry and market assessment. Investors assess the industry and market conditions in which the company operates. They consider factors like market trends, competition, regulatory environment, and potential risks. Step 3. Financial ratios and performance metrics. Investors use financial ratios and performance metrics to evaluate the company's efficiency, profitability, and overall financial health. Common ratios include the price-to-earnings ratio, P/E, debt-to-equity ratio, and return on equity, ROE. Step 4. Management and governance. Investors examine the company's management team's track record, experience, and decision-making abilities. Effective leadership and transparent governance are crucial for long-term success. Step 5. Risk assessment. Investors identify and assess various risks associated with the company and its industry. These may include operational risks, market risks, and regulatory risks. Step 6. Valuation. Investors determine the company's intrinsic value based on its financial performance and future growth potential. This helps them decide whether the current stock price offers a favorable investment opportunity. Step 7. Diversification. Investors consider diversification by spreading their investments across different companies and industries. Diversification helps reduce the impact of individual company or sector-specific risks on their overall portfolio. Step 8. Decision-making. Based on the gathered information and analysis, investors make a decision to either invest in the company's stock or look for other investment opportunities. Importance of investment decision process. A. Minimizing risk. A structured decision process helps investors identify potential risks and take steps to minimize them. By understanding the risks involved, investors can make more informed choices and avoid unnecessary losses. B. Maximizing returns. Thorough research and analysis enable investors to identify companies with strong growth potential and invest in them at an opportune time. This can lead to higher returns on investment. C. Aligning with goals. The decision process helps investors align their investments with their financial goals, such as saving for retirement, funding education, or purchasing a property. Example: investment in technology company. Suppose an investor is considering investing in a technology company. The investor starts by researching the company's financial statements, analyzing its revenue growth over the past few years, and evaluating its profit margins compared to industry peers. Additionally, the investor assesses the industry's outlook, considering factors like technological advancements, market demand, and potential competition. They review the company's management team, looking for experienced leaders with a proven track record in the technology sector. Next, the investor examines various risk factors, such as cybersecurity threats, regulatory changes, and market competition. Based on the company's financial performance and growth prospects, the investor calculates its fair value and compares it to the current stock price. Finally, the investor weighs the investment opportunity against their overall portfolio strategy and risk tolerance. If the company's stock price appears undervalued and aligns with the investor's risk appetite, they may decide to invest in the company. By following a structured investment decision process, the investor can make a well-informed choice, increasing the likelihood of a successful investment outcome. Investment decision process. Investors follow a structured process to evaluate whether they should invest in a company. This involves conducting research, analyzing financial data, and assessing various factors to make informed investment decisions. Avoiding financial crisis. Investors consider the potential risks associated with their investments to avoid contributing to or being negatively affected by another financial crisis. Prudent decision-making and risk assessment are essential to prevent excessive market volatility and instability. Investment decision process steps, with a focus on avoiding financial crisis. Step 1. Research and analysis. Investors thoroughly research the company they are considering for investment. They examine its financial statements, business model, market position, and competitive advantage to gain a comprehensive understanding of the company's strengths and weaknesses. Step 2. Risk assessment. Investors pay particular attention to assessing risks associated with the company and its industry. They identify potential vulnerabilities that could lead to financial distress or bankruptcy. By understanding these risks, they can make more cautious investment choices. Step 3. Financial health and stability. Investors analyze the company's financial health, including its debt levels, liquidity, and ability to generate cash flows. A financially stable company is less likely to face a sudden crisis that could impact the broader market. Step 4. Industry and market conditions. Investors evaluate the industry and market conditions in which the company operates. They look for signs of potential overheating, excessive speculation, or systemic risks that could trigger a crisis. Step 5. Stress testing. Some investors conduct stress tests on their investment portfolios to simulate how they would perform under adverse market conditions. This helps identify potential vulnerabilities and adjust their investments accordingly. Step 6. Diversification. Investors diversify their portfolios by spreading their investments across different assets, industries, and geographies. Diversification can help mitigate the impact of a financial crisis affecting a specific sector or region. Step 7. Monitoring and adjusting. Investors continuously monitor their investments and stay informed about changes in the market environment. If they observe signs of increasing risks or a potential crisis, they may adjust their portfolio allocations accordingly. Importance of avoiding financial crisis in investment decisions. A. Capital preservation. By being cautious about potential risks and avoiding companies with high levels of debt or unstable financials, investors can protect their capital from severe losses during a financial crisis. B. Systemic stability. Prudent investment decisions contribute to overall market stability by reducing the likelihood of large-scale market disruptions caused by unsustainable practices or speculative bubbles. C. Long-term planning. Avoiding risky investments in potential crisis scenarios enables investors to focus on long-term financial goals, such as retirement planning or funding future projects. Example: financial crisis of 2008. During the financial crisis of 2008, many investors suffered significant losses due to exposure to risky assets, particularly mortgage-backed securities with subprime loans. These investments were highly susceptible to default, leading to a cascade of financial failures. Investors who followed a structured decision-making process and were cautious about investing in complex financial instruments were better positioned to avoid the worst impacts of the crisis. Those who assessed risks, diversified their portfolios, and monitored market conditions were able to preserve their capital to a greater extent. Furthermore, the crisis underscored the importance of regulations and risk management in financial markets. Investors learned valuable lessons about the potential consequences of excessive risk-taking and the importance of being mindful of potential systemic risks. As a result, regulators and market participants have since implemented measures to enhance transparency, risk assessment, and investor protection in an effort to prevent future crises. Securities Act of 1933. The Securities Act of 1933 was enacted to ensure that investors receive accurate and transparent information about securities being offered for public sale. The primary goal is to protect investors from fraudulent practices and misrepresentation. Under this act, companies must register their securities with the Securities and Exchange Commission, SEC, and provide relevant information to potential investors through a prospectus. Importance: this act is crucial because it helps investors make informed decisions based on reliable information. By having access to the required disclosures, investors can better assess the risks and potential returns associated with an investment, allowing for more informed choices. Example: if a company plans to issue new shares to raise capital from the public, it must file a registration statement with the SEC, including detailed information about its financial health, business model, risks, and other essential data. Potential investors can access this information in the prospectus before deciding whether to invest in the company. Securities Exchange Act of 1934. The Securities Exchange Act of 1934 established the SEC as the primary regulatory body responsible for overseeing and regulating securities exchanges, broker-dealers, and other participants in the secondary market. It aims to foster fair and efficient markets, promote transparency, and protect investors from fraudulent activities. Importance: this act is critical as it ensures the integrity of the secondary market, where investors buy and sell securities from each other. By maintaining fair and transparent market practices, investors can have confidence in the market's functioning and are more likely to participate. Example: the SEC monitors stock exchanges to ensure that they operate in a fair and orderly manner. It investigates potential market manipulations and insider trading, taking enforcement actions when necessary to maintain market integrity. Sarbanes-Oxley Act of 2002. The Sarbanes-Oxley Act was passed in response to accounting scandals like Enron and WorldCom, aiming to improve the accuracy and reliability of corporate financial disclosures. It holds corporate management accountable for the accuracy of financial statements and internal controls. Importance: this act is essential for investors because it enhances corporate governance and financial reporting. By requiring management to certify financial statements' accuracy, investors can have more trust in the reliability of a company's financial information. Example: if a company's CEO and CFO have to personally certify the accuracy of the financial statements, they are more likely to implement robust internal controls and financial reporting processes. This reduces the likelihood of fraudulent activities and increases investors' confidence in the company. Insider Trading Act of 1988. The Insider Trading Act of 1988 prohibits individuals with access to non-public information from trading securities based on that information. It aims to prevent unfair advantages and ensures a level playing field for all investors. Importance: this act is crucial as it protects investors' interests and maintains market integrity. Insider trading can distort market prices and harm individual investors who do not have access to privileged information. Example: suppose a company executive knows that their company is about to announce a significant loss in its financial results. If they trade their company's stock based on this non-public information before the announcement, it would be considered insider trading. This act imposes severe penalties for such practices, deterring individuals from engaging in insider trading and protecting investors' trust in the fairness of the market. Financial markets are places where people buy and sell financial stuff like stocks, bonds, and other valuable things that can be easily exchanged. There are different types of financial markets, like capital markets and money markets. Capital markets are for long-term finance, while money markets are for short-term finance. In capital markets, you can buy and sell shares of stock or bonds. There are two main types of capital markets: primary markets, where newly issued securities are traded, and secondary markets, where already issued securities are bought and sold regularly. Besides capital and money markets, there are other types of financial markets too. For example, there are derivative markets, where financial instruments whose value depends on other assets are traded, like futures contracts and options. There are also currency markets, where you can convert one currency to another and determine the value of different world currencies. Overall, financial markets are essential for raising funds and conducting various financial transactions. Financial markets, the supermarket of money. Imagine financial markets as a gigantic supermarket where people come to buy and sell different types of money items like financial securities, stocks, bonds, commodities, and other tradable things. Just like a supermarket has different sections, egg, fruits, vegetables, dairy, financial markets have various types too, such as capital markets for long-term money needs and money markets for short-term money needs. Capital markets and money markets, the two money aisles. Think of capital markets as the aisle in the supermarket where you buy things for the long term, like a big bag of rice that will last you a while. On the other hand, money markets are like the quick grab aisle at the checkout counter, where you buy small essential items like candies or gum for immediate use. So capital markets are for long-term financing and money markets are for short-term financing. Primary markets and secondary markets, the two ways to buy stuff. Imagine you want to buy a new smartphone. In the primary market, you buy it directly from the company's store when they first release it, like an initial public offering. But later, if you want to sell the phone to someone else, you'll do it in the secondary market, like an online marketplace or a second-hand store. Now let's practice with some example questions. Example questions. What is the difference between capital markets and money markets? Give an example of each. Capital markets are for long-term financing, and money markets are for short-term financing. For example, if a company wants to raise money for a big expansion project that will take several years, they'll go to the capital market to issue stocks or bonds. On the other hand, if they need money for everyday operations or short-term needs, they'll use the money market to borrow funds for a shorter period, like up to 1 year. Explain the primary market using a real-life scenario. Imagine a popular video game company announces the launch of its latest game console. To raise money for production and marketing, they decide to sell shares of their company to the public. They do this through an initial public offering, IPO, in the primary market. Interested investors can buy these new shares directly from the company at the IPO price. If you want to buy shares of a newly established company, which market would you go to? If you want to buy shares of a newly established company, you would go to the primary market. This is where newly issued securities are sold for the first time. You buy the shares directly from the company when they are offering them to the public for the first time. Advantages and disadvantages of knowing financial markets. Understanding financial markets is crucial for various reasons. Advantages: investment opportunities. Knowing about financial markets helps you identify investment opportunities, allowing you to grow your money over time and secure your financial future. Economic understanding. Understanding financial markets provides insights into how the economy works and how various factors influence it. Capital allocation. Financial markets play a vital role in allocating capital efficiently, directing money to where it's needed most. Risk management. Knowledge of financial markets allows you to make informed decisions about managing risks and protecting your assets. Disadvantages: complexity. Financial markets can be complex and overwhelming, especially for beginners. Without understanding, there's a risk of making uninformed decisions. Market volatility. Markets can be unpredictable, and investments can fluctuate in value. Lack of knowledge may lead to emotional decisions during market volatility. Financial scams. Without proper understanding, individuals may fall prey to financial scams or fraudulent schemes. Overconfidence. Sometimes people with limited knowledge may become overconfident in their abilities and take excessive risks. Overall, knowing about financial markets empowers you to make better financial decisions, but it's essential to continue learning and seeking advice from experts before making significant financial choices. Remember, just like learning any new subject, understanding financial markets takes time and practice. Keep using these mental models and analogies, and gradually, you'll become more confident in your knowledge. Feel free to ask more questions or practice further if needed. Key points I should know about this section: financial markets come in various types, like general and specialized, capital and money, and primary and secondary markets. A financial market is where people buy and sell financial stuff like stocks, bonds, and other tradable items. Capital markets are for long-term finance, while money markets are for short-term finance. Stock markets and bond markets are examples of capital markets that provide financing through issuing shares of stock or bonds. The primary markets deal with newly issued securities, while the secondary markets involve the continuous buying and selling of already issued securities. Financial markets are essential for raising funds and conducting financial transactions in the economy. Derivatives are financial instruments whose value depends on the value of something else, like futures contracts or options. Currency markets enable currency conversion and determine the relative value of different world currencies. Financial markets play a significant role in the economy, helping businesses raise money and investors find opportunities. Other markets, such as derivatives and currency markets, are also part of the broader financial market landscape, beyond just capital and money-related transactions. Financial markets have an essential role in allocating money from people who have it to those who need it. There are two main types of financial markets: capital markets and money markets. Capital markets help businesses get long-term funds for expansion, while money markets provide short-term funds for day-to-day expenses. Financial markets attract money from investors and direct it to companies that use it for their operations and growth. Money borrowed from money markets is for short-term needs, while capital markets offer long-term funding for big investments. Banks play a crucial role by taking deposits from savers and lending that money to those who want to borrow. In more complex transactions, financial markets act as places where lenders and borrowers meet, and existing borrowing or lending commitments can be bought or sold. One example of this is the stock exchange, where companies can raise money by selling shares to investors, and existing shares can be bought or sold by traders. Overall, financial markets help businesses and individuals find the money they need to grow and achieve their goals. Without them, it would be challenging for borrowers to find lenders, and economic progress would be hindered. Explanation in simple terms. Financial markets are like a big marketplace where people who have money, capital, can lend it to those who need money. It's like connecting people who want to invest their money with businesses and others who need money for various reasons, like starting a business or expanding an existing one. Mental models and analogies. The money matchmaker. Think of financial markets as a matchmaker for money. Just like a matchmaker brings together people looking for love, financial markets bring together people with money, investors, and people who need money, borrowers. The financial highway. Imagine financial markets as a highway where money flows from one place to another. Investors put their money on this highway, and it travels to businesses and individuals who need it to grow and achieve their goals. Quick example exercises. A. What is the main role of financial markets? Answer. The main role of financial markets is to allocate capital by matching those who have money with those who need it. B. How do capital markets differ from money markets? Answer. Capital markets deal with long-term finance, while money markets handle short-term finance. Advantages and disadvantages. Advantages. Financial markets help businesses grow and create more opportunities for everyone. Investors can earn returns on their investments, increasing their wealth. It provides a way for people to save money for the future and earn interest. Disadvantages. Financial markets can be complex, and some people may lose money if they make risky investments. There can be periods of volatility and uncertainty, affecting investors and businesses. In some cases, financial markets may favor certain wealthy individuals or institutions. Why it's important to know. Understanding financial markets is crucial because they play a vital role in the economy. By allocating capital efficiently, financial markets contribute to economic growth and development. Knowing how financial markets work can help individuals make better financial decisions, manage risks, and plan for their future financial well-being. It's also essential for businesses to access funding and expand their operations. Key points I should know about this section. Financial markets help match people with money, capital, to those who need it. Capital markets raise money for long-term needs, while money markets handle short-term needs. Businesses get funds from financial markets to grow and run their operations. Without financial markets, it would be tough for borrowers to find lenders on their own. Banks and other intermediaries play a crucial role in this process by taking deposits and lending money. Bank deposits are a simple way to allocate capital from savers to businesses. More complex transactions require markets like the stock exchange, where companies can raise money by selling shares to investors. Financial capital is the money used by businesses to buy what they need for their products or services. Understanding financial markets is essential for making smart financial decisions and planning for the future. Financial markets help the economy grow by connecting investors and borrowers, leading to more opportunities for everyone. By grasping these key points, you'll have a good foundation for understanding how financial markets work and their importance in our economic system. Financial markets play a role in providing feedback to businesses and their management. They work through the interaction of buyers and sellers, determining the prices of assets being traded. Based on the demand and supply of funds, financial markets signal how money should be allocated in the economy. For businesses, financial markets can be like a mirror, reflecting how potential shareholders perceive their value compared to competitors. When investors buy or sell shares, it affects the stock price, giving managers feedback on how their company is viewed by the market. However, the feedback from financial markets may not always be straightforward. The stock market can be influenced by various factors, leading to oscillations in stock prices. So while it provides valuable information, managers need to interpret it carefully for making sound decisions. In essence, financial markets help businesses understand how they are perceived and valued by investors. But managers must consider the bigger picture and use other tools, like market research, to make informed decisions. Simple explanation. Financial markets are like a communication system between people who want to invest their money, buyers, and businesses that need funds, sellers. These markets help determine the prices of assets and provide feedback to business managers about how investors perceive their company's value. Mental model, the feedback mirror. Imagine financial markets as a big mirror reflecting how investors see a company. When the stock price goes up, it's like a thumbs-up signal to the managers, saying investors believe in the company. But when the stock price goes down, it's a signal for managers to pay attention and figure out what needs improvement. Example exercise. Question. What role do financial markets play in the economy? Answer. Financial markets help allocate funds by matching investors with businesses that need capital. They determine prices through the demand and supply of assets, providing feedback to managers about their company's value. Advantages and disadvantages. Advantages. Financial markets provide valuable feedback to managers, helping them understand how investors view their company. This information can guide decision-making and improve the business's performance. Disadvantages. Financial markets can be volatile and unpredictable, leading to sudden fluctuations in stock prices. This can make it challenging for managers to interpret feedback accurately and make long-term plans. Why is it important to know? Understanding financial markets and their feedback role is crucial for managers and businesses. It helps them gauge investor confidence, identify areas for improvement, and make informed decisions. By grasping this concept, managers can navigate the complex world of finance and work towards the growth and success of their company. Key points I should know about this section: financial markets bring buyers and sellers together to trade assets like stocks and bonds. These markets determine asset prices through the interaction of buyers and sellers. They also help allocate funds in the economy based on the demand and supply of assets. Managers often lack complete information about their business, so they seek feedback to make better decisions. Market research is one way managers gain feedback, understanding what customers want and need. Financial markets can also provide feedback to managers through the stock market. For example, when a company's stock price rises, it shows investors have confidence in the company. However, the stock market can be unpredictable and feedback can fluctuate, making it less reliable for decision-making. More complex financial transactions, like those on the stock exchange, require specialized markets for buyers and sellers to meet. Understanding feedback from financial markets is essential for managers to make informed short-term and long-term decisions for their businesses. Financial markets can give valuable information to managers about their business. They work by bringing together buyers and sellers to set prices for assets, like stocks and bonds. These markets help allocate money in the economy based on the demand and supply of assets. Managers often lack complete information about their own business, so they use market research to get feedback from customers. Financial markets also provide feedback to managers through the stock market, showing how investors view a company's value compared to its competitors. However, stock markets can be unpredictable, so this feedback may not always be reliable for decision-making. Complex transactions, like those on the stock exchange, need special markets where lenders and borrowers can meet. Knowing and understanding this feedback is essential for managers to make better decisions for their business in both the short and long term. Simple explanation: financial markets are like a big marketplace where people buy and sell things called assets, such as company stocks. These markets can show how much money investors are willing to give to a business. This information helps managers understand how much people believe in their company's future. Mental model: the marketplace. Imagine a busy marketplace where buyers and sellers come together. The buyers, investors, are interested in buying things like company shares, and the sellers, companies, want to raise money by selling those shares. The price at which the shares are bought and sold can tell us how much investors value that company. Practice exercise: what are financial markets? Financial markets are places where people buy and sell assets, like stocks and bonds. How do financial markets determine the price of assets? Financial markets use the interaction of buyers and sellers to decide the prices of assets. How can financial markets help managers understand their business better? Financial markets can provide feedback to managers about their business by showing how much investors are willing to invest. Advantages and disadvantages. Understanding financial markets and their feedback is crucial for managers and businesses. It allows them to access funding for growth and expansion. However, the stock market's fluctuations can sometimes provide misleading feedback, making it important for managers to analyze information carefully and make informed decisions. Knowing how financial markets work and the feedback they provide helps managers make better decisions for their company's future success. It enables them to understand investor sentiment, assess their company's value, and adjust their strategies accordingly. However, they must also be aware of the stock market's inherent volatility and consider other sources of information to make well-informed choices. Key points I should know about this section: financial markets are places where people buy and sell assets, like stocks and bonds. Financial markets work through the interaction of buyers and sellers. When many people want to buy a particular asset, its price goes up. When more people want to sell it, the price goes down. Financial markets help allocate funds in the economy. When a company wants to grow or start a new project, it can raise money by selling its stocks to investors in the financial market. Management of companies may not know everything about their business or how investors perceive it. they might not be fully aware of how much others are willing to invest in their company. To get feedback on their business, managers conduct market research to understand what customers and investors think about their products or services. Financial markets also provide feedback to management. For example, if a company's stock price goes up, it shows that investors have confidence in the company's potential for growth. However, the stock market can be unpredictable. Prices can change rapidly, going up and down frequently, which is called oscillation. This constant change in stock prices means that the feedback from the stock market may not always be reliable for making important decisions. For more complicated transactions, like raising a large amount of money, specialized markets like the stock exchange are needed. These markets connect lenders, investors, with borrowers, companies. Understanding feedback from financial markets is crucial for making informed decisions. It helps managers know how investors view their company and how well it is performing compared to others in the same industry. Being aware of market signals can guide managers in their short-term and long-term strategies. The Securities Act of 1933 is a law that aims to protect regular investors by ensuring they receive all the necessary and accurate information before they invest in public securities like stocks and bonds. The main purpose is to prevent fraud and provide transparency. To achieve this, companies offering securities to the public must register with the U.S. Securities and Exchange Commission, SEC, and provide detailed information about their business, management, and financial statements. There are some exceptions to the registration requirement, such as private placements, which involve selling securities to a small group of chosen investors. Rule 144 is a provision that allows the sale of restricted and controlled securities without registration under certain conditions. Regulation S is another provision that defines when an offering of securities is considered to be executed in another country and therefore exempt from registration in the United States. Overall, the Securities Act of 1933 ensures that investors have access to complete and accurate information so they can make informed decisions about their investments. The law is enforced by the SEC, which is responsible for regulating the securities industry and protecting investors in the United States. The Securities Act of 1933 is like a set of rules that make sure people get all the important information before they buy investments like stocks or bonds. It's designed to protect regular investors and prevent fraud. Companies that want to sell their securities to the public must follow these rules, share details about their business, and get approval from the government. Mental models and analogies. A. The menu analogy. Imagine you're at a restaurant and you want to order a dish. Before you decide, the waiter gives you a menu with all the information about each dish, the ingredients, how it's made, and the price. The Securities Act is like that menu. It ensures that before you invest in a dish, buy securities, you have all the information you need to make a good choice. The safety check analogy. Just like how you check the safety features of a car before buying it, the Securities Act checks if the investment is safe for regular investors. It ensures that companies provide complete and accurate information, so you know what you're getting into and can avoid any potential dangers. Example exercises. And why is the Securities Act of 1933 important for investors? The Securities Act is important because it protects investors by making sure they have all the necessary information before investing in securities. It helps prevent fraud and ensures transparency in the market. B. What does the Act require companies to do before they can sell securities to the public? The Act requires companies to provide material financial and corporate information about their securities, like stocks and bonds, to potential investors. They must register with the SEC and share details about their business, management, and financial statements. C. Explain Rule 144 in simple terms. When can it be used? Rule 144 allows the sale of restricted and controlled securities without registration under certain conditions. For example, if you own shares in a company but can't sell them to the public immediately, Rule 144 might allow you to sell them under specific restrictions. What is Regulation S? How does it provide a safe harbor? Regulation S is a provision that defines when the offering of securities is considered to be executed in another country and is exempt from the registration requirement in the United States. It provides safe harbor rules for securities offered and sold outside the U.S. advantages and disadvantages. The advantages of the Securities Act of 1933 are investor protection. It ensures investors get complete and accurate information, reducing the risk of scams and fraud. Transparency. Companies must disclose vital details, giving investors a clear picture of the investment's potential risks and rewards. Market stability. By preventing deceptive practices, it helps maintain confidence in the financial markets. The disadvantages are compliance burden. Companies need to go through a rigorous registration process, which can be time-consuming and costly. Limitations on private placements. Some businesses may find it challenging to raise capital privately due to restrictions under the Act. International challenges. The Act's regulations might make it harder for U.S. companies to access international markets. Why is it important to know? Understanding the Securities Act of 1933 is crucial for both investors and businesses. For investors, it helps ensure they have the information needed to make informed decisions and avoid potential scams. For businesses, it's essential to comply with the Act's requirements to gain public trust and access the financial markets. Knowing the Act's provisions also contributes to a fair and transparent financial system, benefiting the overall economy. Key points I should know about this section. Purpose of the Securities Act. The main goal of the Securities Act of 1933 is to protect investors by ensuring they receive complete and accurate information before investing in securities. Providing information. The Act requires companies to provide material financial and corporate information about their securities to potential investors, such as stocks and bonds. Registration requirement. Unless they qualify for an exemption, companies must register their securities with the U.S. Securities and Exchange Commission, SEC, before offering them to the public. Exemptions and private placements. Some transactions, like private placements, may be exempt from the Act's registration requirement, allowing companies to sell securities to a limited group of chosen investors. Role of the SEC. The SEC is a federal agency responsible for enforcing securities laws and regulating the securities industry in the United States. Rule 144. Rule 144 is a provision that permits the sale of restricted and controlled securities under specific conditions without the need for registration. Rule 144 requirements. To use Rule 144, certain conditions must be met, such as a minimum holding period and limitations on the amount of securities that can be sold. Regulation S. Regulation S provides a safe harbor that defines when an offering of securities is considered executed in another country and exempt from registration in the U.S. regulations requirements. For Regulation S to apply, offers and sales of securities must be made outside the United States, and no directed selling efforts should target U.S. persons. Prospectus. Companies must prepare a prospectus, which is a document that provides important information about the securities being offered to potential investors. Importance of knowing. Understanding the Securities Act of 1933 is crucial for both investors and companies. For investors, it ensures they have the necessary information to make informed decisions and avoid fraudulent schemes. For companies, compliance with the Act builds trust with investors and helps them access the public markets more transparently. The Act plays a significant role in maintaining the integrity and stability of the financial markets, benefiting the economy as a whole. The Securities Exchange Act of 1934 is a law in the United States that controls the buying and selling of securities like stocks and bonds. It regulates various aspects of the financial markets and those involved in trading securities. The law created the Securities and Exchange Commission, SEC, which is responsible for enforcing federal securities laws. The Act covers both the physical places where securities are traded, like stock exchanges, and the newer digital systems, like NASDAQ, which allows trading without a physical location. Over time, brokers have also developed alternative trading systems, ATS, for smaller private networks of traders. To ensure transparency and protect investors, companies that issue securities in the primary market must regularly provide information to the SEC if they have a certain number of shareholders and assets. The Act also includes measures against fraud in the secondary market, where securities are traded between individuals and not directly from the issuing company. In summary, the Securities Exchange Act of 1934 is a law that oversees the buying and selling of securities, regulates financial markets and participants, and aims to protect investors from fraud. It established the SEC and applies to both physical and digital trading systems. Imagine the Securities Exchange Act of 1934 as a set of rules that control how people can buy and sell securities, like stocks and bonds, in the United States. It's like a referee in a sports game that makes sure everyone plays fair and follows the rules during the trading process. Mental model. Think of the Securities Exchange Act as a traffic cop for the stock market. Just like a traffic cop regulates the flow of vehicles on the road, This law regulates the flow of securities in the financial markets. It ensures that everything runs smoothly and safely for investors and traders. Example exercise. Question. What does the Securities Exchange Act of 1934 regulate? Answer. The Securities Exchange Act of 1934 regulates the buying and selling of securities, like stocks and bonds, in the United States, both on physical exchanges and newer digital platforms, like NASDAQ. Advantages and disadvantages. Advantages. The Act provides transparency and safeguards for investors in the secondary market, where most trading happens. It establishes rules and oversight to prevent fraud and ensure fair practices. The law helps maintain market stability and investor confidence. Disadvantages. Some argue that the Act may impose too many regulations, potentially limiting market flexibility. Adapting the Act to rapidly evolving digital trading platforms can be challenging. Compliance with the Act can be costly and time-consuming for companies. Why is it important to know? Understanding the Securities Exchange Act of 1934 is crucial for investors, traders, and companies involved in the stock market. It helps protect investors from fraud and ensures that the financial markets function fairly and efficiently. Companies' compliance with the Act's reporting requirements is essential for maintaining transparency and building investor trust. Knowing the Act's regulations can also help individuals make informed decisions when buying or selling securities, reducing the risk of potential pitfalls in the market. Key points I should know about this section: the Securities Exchange Act of 1934 governs how securities, like stocks and bonds, are bought and sold in the United States, specifically in the secondary market. Regulation basis. It forms the foundation for regulating financial markets and the people involved in trading securities within the U.S. covered exchanges. The law oversees actual securities exchanges, such as the New York Stock Exchange, American Stock Exchange, and regional ones like Cincinnati and Philadelphia Stock Exchange. Broker-dealers regulation. The Act also regulates broker-dealers who trade securities without a special status. Telecommunications infrastructure. A system was developed to enable trading without the need for a physical location, and this gave rise to the NASDAQ, an electronic stock market. Maloney Act Amendment. In 1938, the Exchange Act was amended by the Maloney Act, which allowed for the formation and registration of national securities associations supervised by the SEC. ATS, Alternative Trading System. Brokers introduced an alternative system known as ATS, a smaller private network where stocks are bought and sold outside traditional exchanges. Self-regulatory organizations, SRO. The Maloney Act led to the creation of the National Association of Securities Dealers, NASD, which became an SRO responsible for overseeing brokers and brokerage firms, including NASDAQ. Disclosure requirements. The Act requires companies to regularly provide information to the SEC if they have a certain number of shareholders and assets, ensuring transparency in the secondary market. Anti-fraud provisions. While the Act extends disclosure requirements, there were questions about whether individuals could sue issuers for fraud under the Act. Understanding these points will help you grasp the importance of the Act in regulating financial markets, protecting investors, and ensuring fair trading practices. The Sarbanes-Oxley Act, SOX, is a law in the United States that was created to make sure that public companies are held to higher standards of honesty and accuracy. It was made in response to some big scandals in the business world, like Enron and WorldCom, which caused a loss of trust in the financial markets. SOX made some important changes. It requires top managers of companies to personally guarantee the accuracy of financial information. It also increased the penalties for fraudulent financial activities. The law made auditors more independent and increased the role of company boards in overseeing financial matters. The law is named after the two politicians who sponsored it, Senator Paul Sarbanes and Representative Michael Locksley. It led to the creation of the Public Company Accounting Oversight Board, PCAOB, which oversees auditing firms and ensures they comply with the law. Some people argue that SOX has made things too complicated for American businesses, making it harder for them to compete internationally. However, others believe that it has been beneficial by boosting the confidence of investors in the truthfulness of financial statements. Overall, SOX is a set of rules that aim to promote transparency and honesty in the financial world, but opinions on its effectiveness are divided. Explanation in simple terms. The Sarbanes-Oxley Act, SOX, is like a set of strict rules for all big companies in the U.S. It makes sure that company leaders are more responsible for telling the truth about their finances, and if they lie or cheat, they will face harsh punishments. The law also makes sure that the people who check a company's finances are independent and not influenced by the company itself. Mental models and analogies. A. The honest housekeeper. Think of a company as a house and its finances as the rooms in that house. The company leaders are like the housekeepers who have to make sure everything is tidy and clean. Sarbanes-Oxley is like a strict supervisor who checks if the housekeepers are doing their job honestly and making sure the rooms are in order. If they find any mess or lies, the housekeepers will get into big trouble. B. The auditor detective. Imagine an auditor as a detective who investigates a company's finances to see if everything is correct. Sarbanes-Oxley is like the detective's boss, making sure the detective is unbiased and not friends with the suspects. This way, the detective can uncover any tricks or hidden things companies might try to hide. Example exercises and questions. And why was the Sarbanes-Oxley Act created? The Sarbanes-Oxley Act was created in response to major corporate scandals like Enron and WorldCom to ensure more honesty and transparency in the financial world. B. What are the key points of SOX that affect top management? Top management now has to personally guarantee the accuracy of financial information, and penalties for fraudulent financial activities are much more severe. C. How did SOX change the role of outside auditors? SOX increased the independence of outside auditors so they can give unbiased opinions on a company's financial statements. Name one major corporate scandal that led to the creation of SOX. E. What is the purpose of the Public Company Accounting Oversight Board, PCAOB? Enron is one major corporate scandal that led to the creation of SOX. E. The PCAOB oversees auditing firms and ensures they follow the rules set by SOX. Advantages and disadvantages plus importance. Advantages. Increased accountability. SOX makes sure that company leaders are responsible for accurate financial information, which can build trust with investors and the public. Reduced fraud. Stricter rules and harsh penalties can deter companies from committing financial fraud. Improved investor confidence. Investors may feel more secure knowing that there are checks in place to ensure the accuracy of financial statements. Disadvantages. Compliance costs. Implementing SOX can be expensive for companies due to the need for increased monitoring and reporting. Competitive disadvantage. Some opponents argue that the regulations might make U.S. companies less competitive compared to foreign companies with less strict rules. Complexity. SOX can be complex, and complying with its provisions may be challenging for some companies. Importance. Knowing about the Sarbanes-Oxley Act is crucial because it affects how companies manage their finances, how auditors work, and the level of trust investors and the public have in the financial system. Understanding SOX helps ensure transparency and honesty in the business world, which can have a significant impact on the economy and investors' confidence. Key points I should know about this section. Purpose of SOX. The Sarbanes-Oxley Act, SOX, was created to make sure all big U.S. companies follow strict rules and are more honest about their financial information. Certification of financial information. Top management of public companies must personally guarantee that the financial information they provide is accurate and true. Stronger penalties. SOX increased the punishments for companies and people involved in fraudulent financial activities, making them face severe consequences. Independent auditors. The Act ensures that the auditors who check a company's finances are unbiased and not influenced by the company itself. Boards of directors' role. SOX gives more responsibility to the boards of directors of companies, making them oversee financial matters more carefully. Reaction to scandals. The law was created as a response to major corporate scandals like Enron and WorldCom, which damaged public trust in the financial system. Global impact. Other countries, like Japan, Germany, and Australia, have also enacted similar laws inspired by SOX to strengthen their financial governance. Public Company Accounting Oversight Board, PCAOB. This board oversees the auditors and makes sure they follow the rules set by SOX. Corporate responsibility. Senior executives of companies have to take personal responsibility for the accuracy and completeness of financial reports. Enhanced financial disclosures. Companies are required to report more detailed information about financial transactions and internal controls. Importance of knowing SOX. Understanding the Sarbanes-Oxley Act is crucial because it promotes honesty, transparency, and accountability in the business world. It helps build trust among investors and the public, ensuring that companies provide accurate financial information. This, in turn, can lead to a more stable and reliable financial system. Remember, SOX is all about keeping companies and their leaders honest and responsible, and making sure that financial information is accurate and trustworthy. In today's financial services world, there are 8 major types of financial institutions that offer different services, such as loans and investments, to individuals and businesses. These institutions play a crucial role in regulating the economy, promoting fairness in financial practices, and supporting prosperity. Central banks. These banks oversee and manage all other banks, and in the United States, the Federal Reserve Bank is the central bank responsible for conducting monetary policy and supervising financial institutions. Retail and commercial banks. They offer products like deposit accounts, loans, and financial advice to both individuals and businesses. Some operate online as internet banks, credit unions, nonprofit institutions owned and operated by their members, providing traditional banking services to a specific group or the general public with minimal requirements. Savings and loan associations, S&L. These institutions provide checking accounts, personal loans, and home mortgages and are often community-focused. Investment banks, they act as intermediaries in complex transactions, help with initial public offerings, IPOs, and provide financial advice to large clients. Brokerage firms assist individuals and institutions in buying and selling securities like stocks, bonds, and mutual funds. Insurance companies. These institutions help individuals and businesses transfer the risk of financial loss due to various events. Mortgage companies specialize in providing mortgage loans to consumers or commercial real estate. Financial institutions are generally safe places to keep money due to government insurance provided by agencies like the FDIC and NCUA. Cryptocurrency exchanges operate in a complex regulatory environment, with different authorities treating them as securities, commodities, or currencies. Understanding these financial institutions is essential for making informed decisions about managing finances and investments. Financial institutions. Simplified explanation. Financial institutions are like big stores that offer different financial products and services. Imagine them as a supermarket for money-related stuff. They have a wide range of things you can buy with your money, like deposit accounts, loans, and investment opportunities. Just like how you go to different stores for specific things you need, you choose a financial institution based on what you want to do with your money. Mental model. A financial supermarket. Think of financial institutions as a giant supermarket with various sections, a banking aisle, an investment section, an insurance corner, and so on. Each section offers different products tailored to specific needs. You decide which section to visit based on what you need, like getting a loan or saving for the future. Each section has its own experts to guide you in making the right choices. Quick examples and questions. Which type of financial institution oversees and manages all other banks? Answer. Central banks question. What is the central bank in the United States called? Answer. The Federal Reserve Bank, Fed. B. What are the 2 main types of banks that offer services to both consumers and businesses? Answer. Retail and commercial banks. C. Credit unions are owned and operated by whom? Answer. Their members, people who use their services. What type of financial institution helps individuals transfer the risk of loss? Answer. Insurance companies. E. Why are banks and credit unions generally safe places to keep your money? Answer. Because they are insured by the federal government, protecting your money in case of problems. Advantages and disadvantages plus importance. Advantages. Financial institutions offer a wide range of services to meet various financial needs. They play a vital role in regulating the economy, ensuring fair practices, and supporting economic growth and stability. Disadvantages. Some financial institutions may have complex rules or high fees, which could be a disadvantage for certain customers. It's essential to understand their terms and conditions before making decisions. Importance. Knowing about different financial institutions is crucial because it allows you to make informed choices about managing your money, getting loans, investing, and protecting yourself from financial risks. Remember, just like shopping in a supermarket, it's essential to explore and compare different financial institutions to find the one that suits your needs best. By using these mental models and analogies, you can make the topic of financial institutions more relatable and easier to understand and remember. Key points I should know about this section. Purpose of financial institutions. Financial institutions provide various financial products and services like deposit accounts, loans, and investment opportunities to individuals and businesses. Types of financial institutions. There are 8 major types of financial institutions. A. Central banks oversee and manage all other banks, like the Federal Reserve in the U.S. B. Retail and commercial banks offer services to consumers and businesses, including checking accounts, loans, and credit cards. C. Internet banks operate online and provide similar services to traditional banks. Credit unions, nonprofit institutions owned by members, providing banking services with reduced fees. E-savings and loan associations offer checking accounts, personal loans, and home mortgages, primarily focusing on residential real estate lending. F. Investment banks act as intermediaries in complex transactions, help companies raise capital through securities issuance. G. Brokerage firms assist individuals and institutions in buying and selling securities like stocks and bonds. At insurance companies, transfer the risk of loss due to various events like accidents and property damage. Economic regulation, financial institutions play a crucial role in regulating the economy, ensuring fair financial practices, and promoting prosperity. Central bank function. Central banks oversee and regulate other banks and conduct monetary policy to stabilize the economy. Credit union membership. Historically, credit unions serve specific demographic groups, but many now allow the general public to join with minimal requirements. Insurance for risk management. Insurance companies help individuals and businesses protect against financial losses caused by various unforeseen events. Mortgage companies. These institutions specialize in originating or funding mortgage loans for individuals or commercial real estate. Safety of financial institutions. Banks and credit unions are generally safe because they are insured by the government, up to $250,000 in combined total balances. Cryptocurrency exchanges. The regulatory framework for cryptocurrency in the U.S. is complex, with different agencies classifying it as a security, commodity, or currency. Financial intermediaries. Financial intermediaries, like banks, act as middlemen in financial transactions, lowering the cost of doing business. Remember, financial institutions are essential for the functioning of the economy and provide a range of services to meet the needs of consumers and businesses. Strategic financial management is all about managing a company's finances with the intention of succeeding in the long term. It aims to create profits for the business and maximize returns for shareholders over time. Unlike short-term tactical management that seizes immediate opportunities, strategic financial management focuses on long-term gains and requires careful planning and decision-making. To be strategic, a company needs to define its objectives precisely, identify its available and potential resources, and create a specific financial plan to achieve its goals. This involves understanding and controlling a company's assets and liabilities, monitoring financial items like expenses, revenues, and cash flow. Strategic financial management also means making trade-offs between short-term and long-term goals. Sometimes a company may need to sacrifice short-term gains to achieve better results in the future. For example, it might reduce expenses now to position itself for success in the long run, even if it leads to short-term losses. Key elements of strategic financial management include planning, precisely defining objectives, identifying resources, and creating a specific financial plan. Budgeting. Efficiently managing finances, reducing waste, and ensuring enough liquidity for operating expenses. Risk management. Analyzing and mitigating uncertainty in investment decisions and employing risk metrics. Ongoing procedures, collecting and analyzing data, making consistent financial decisions, and taking corrective actions when needed. Strategies for strategic financial management can vary based on the industry and sector a company operates in. Companies in fast-growing industries may focus on growth and revenue, while those in slow-growing sectors may prioritize cost reduction and asset protection. The benefits of strategic financial management include maintaining long-term goals even in challenging times, ensuring profitability, and providing stability to the company. It covers all aspects of a firm's long-term objectives, with financial management playing a significant role in cost reduction, risk management, and budgeting. The ultimate objective of strategic financial management is to ensure that long-term goals are well planned and achieved successfully. Simple explanation. Strategic financial management means managing a company's money with a plan to succeed in the long term. It's about making profits and maximizing returns for the owners, shareholders, over time. It's like playing chess, where you plan several moves ahead to win the game. Mental model, sailing a ship. Think of a company as a ship sailing in the vast ocean of business. Strategic financial management is like plotting the course and navigating the ship to reach a specific destination, long-term goals, while avoiding storms and obstacles, short-term challenges. It involves managing resources, sales, crew, supplies, efficiently to ensure a smooth and profitable journey. Practice questions. What is the main goal of strategic financial management? The main goal is to succeed in the long term by making profits and maximizing shareholder value. B. How does strategic financial management differ from tactical management? Strategic management focuses on long-term success, while tactical management is about short-term decisions. C. Give an example of a short-term trade-off a company might make for long-term success. A company might choose to reduce expenses now to position itself better for success in the future, even if it leads to short-term losses. Name 3 elements of strategic financial management: planning, budgeting, managing, and assessing risk. E. Why is it essential for companies to have a long-term focus in financial management? Having a long-term focus helps companies stay profitable and stable, even during challenging times. Breaking it down, advantages of strategic financial management. Long-term success. Companies with strategic financial management are better prepared to achieve their long-term goals. Stability. Having a plan in place helps companies stay stable and profitable, even during tough times. Efficient resource use. Strategic management ensures resources are used wisely and wastage is minimized. Shareholder value. Maximizing returns for shareholders keeps them happy and invested in the company. Disadvantages of strategic financial management. Short-term sacrifices. Sometimes companies need to make short-term sacrifices for long-term gains, which can be challenging. Uncertainty. The future is unpredictable, and strategic plans may need adjustments as circumstances change. Complex decision-making. Strategic financial management requires careful analysis and decision-making, which can be time-consuming. Importance of knowing strategic financial management. Understanding strategic financial management is crucial for businesses to plan and achieve long-term success. It helps them navigate through uncertainties, make informed decisions, and use resources efficiently. By focusing on the long term and maximizing shareholder value, companies can thrive and remain competitive in the market. Key points I should know about this section: meaning of strategic financial management. It's not just managing a company's money. It's managing it with a plan to succeed in the long term. The goal is to achieve the company's long-term objectives and maximize shareholder value over time. Creating profits over the long run. Strategic financial management aims to make profits for the business over a long period. It's like growing a tree to bear fruit for many years, rather than just picking the fruit once. Maximizing return on investment. It focuses on maximizing returns for the owners, shareholders, over time. It's like making the most out of your investment in a video game, playing smartly to hit the highest score. Difference from tactical management. Tactical management is about short-term gains, while strategic management looks at the bigger picture for long-term success. It's like deciding whether to buy a small treat now or save money for a bigger reward later. Importance of a financial plan. A strategic financial plan is all about long-term gain. It's like planning a roadmap to reach a distant destination, ensuring you stay on track to achieve your goals. Understanding and controlling finances. Strategic management involves understanding and controlling a company's money, assets, and debts. It's like a chef managing all the ingredients to make a perfect dish. Continuous evaluation and planning. Strategic financial management keeps the company focused and on track towards long-term goals. It's like a captain continuously adjusting the ship's course to reach the desired destination. Managing capital structure. It involves assessing and managing how a company uses debt and equity finance to ensure its long-term financial stability. It's like balancing the right mix of water and food for a plant to grow strong. Elements of strategic financial management. Some common elements include planning objectives, budgeting efficiently, managing risks, and establishing ongoing procedures. It's like having different tools in a toolbox to fix various problems. Strategies based on industry. Financial management strategies vary based on the industry a company operates in. It's like using different playbooks for different sports to win games effectively. Understanding strategic financial management is essential for companies to plan and achieve long-term success. It helps them navigate uncertainties, make wise decisions, and use resources efficiently, ultimately leading to stable and profitable businesses. The Insider Trading Act of 1988 was a law that made changes to the Securities Exchange Act of 1934. It was signed by President Ronald Reagan and aimed to strengthen the enforcement of insider trading laws. The act increased penalties for all parties involved in insider trading, including fines and jail time. Since then, there have been several high-profile cases of insider trading, such as Martha Stewart's involvement in the Clone case. Insider trading is when people outside a company use non-public information to trade stocks and make money unfairly. The act allows the SEC to impose heavy fines and jail sentences on those who engage in insider trading. It was introduced due to an increase in such cases and the large amounts of money involved. Some well-known cases of insider trading include Martha Stewart's and a former Amazon financial analyst's involvement. Insider trading has a long history, and laws have evolved to require prompt reporting of actions related to dividends and company stock transactions. While some insider trading is legal, using private information to gain an unfair advantage is against the law. The Insider Trading Act of 1988 is a law that was added to the Securities Exchange Act of 1934. It gives more power to the Securities and Exchange Commission, SEC, to enforce rules against insider trading. Insider trading is when people use secret information to make money by buying or selling stocks. This law makes the penalties for insider trading stricter, and people involved in such illegal activities can be fined heavily or even go to jail. Mental model: playing by the rules. Imagine a game where everyone has to follow certain rules to play fair. The Insider Trading Act is like a new rule added to the game of stock trading. It tells people that they cannot use secret information to win unfairly. If someone breaks this rule, they will get a big penalty, like losing their points or even getting kicked out of the game. Example exercises. What is the purpose of the Insider Trading Act of 1988? The purpose is to make it harder for people to do insider trading and enforce rules against it. Who signed the Insider Trading Act into law, and when did it happen? The act was signed by President Ronald Reagan on November 19, 1988. Why was the Insider Trading Act introduced? It was introduced because there were many high-profile insider trading cases and big money involved in those trades. Advantages and disadvantages and importance. Advantages. The Insider Trading Act helps protect investors and the stock market from unfair practices. It increases penalties for insider trading, making it a more serious offense. It gives the SEC more power to catch and punish those involved in insider trading. Disadvantages. Some argue that the penalties may not be harsh enough to deter insider trading completely. It can be challenging to catch every instance of insider trading, so some cases may still go undetected. Importance. The Insider Trading Act is essential because it helps maintain fairness and trust in the stock market. Insider trading can give certain individuals an unfair advantage, which is harmful to other investors and the integrity of the market. By having stricter rules and penalties, the Act aims to deter illegal practices and promote a level playing field for all investors. Key points I should know about this section. The Insider Trading Act of 1988 is an amendment to the Securities Exchange Act of 1934, which is a law that governs the stock market and its regulations. The primary purpose of the Insider Trading Act is to strengthen the enforcement of laws against insider trading. Insider trading involves using non-public information to buy or sell stocks, giving some individuals an unfair advantage in the stock market. The act was signed into law on November 19, 1988 by then-President Ronald Reagan. It is also known as the Insider Trading and Securities Fraud Enforcement Act of 1988, ITSFEA. The act increased the penalties for insider trading, making it riskier and more costly for those involved in such illegal activities. People who illegally share inside information leading to insider trading can face imprisonment and fines. The Securities and Exchange Commission, SEC, is responsible for enforcing the laws related to insider trading. The SEC can impose significant monetary penalties. Often multiples of the profits gained from insider trades, and guilty parties may serve up to 10 years in jail. Since the Act's implementation, there have been several well-known cases of insider trading, including Martha Stewart's involvement in the 2001 Clone case, and other notable instances like the case of former Amazon financial analyst Brett Kennedy in 2017. Importance of the Insider Trading Act. The Insider Trading Act of 1988 is essential for maintaining a fair and transparent stock market. By imposing stricter penalties for insider trading, the Act discourages illegal practices and helps protect the interests of individual investors. It ensures that all market participants play by the same rules, promoting confidence in the financial system. The Act also strengthens the authority of the SEC to enforce regulations, making it more challenging for individuals to engage in insider trading without facing severe consequences.